Most people think a debt crisis begins when a government cannot borrow anymore. That is not usually how it begins. It begins when a government can still borrow, but only by making the currency weaker, the saver poorer, and the future narrower. That is a much quieter crisis. It does not arrive with a single dramatic default headline. It arrives through erosion, a little less purchasing power here, a little more interest expense there, a little more pressure on policymakers to do something they would rather not admit they are doing. Then one day the public looks up and realizes the cost of living climbed, the value of safe savings slipped, and the government somehow made progress on its debt burden without ever truly paying the debt down. I want you to understand that mechanism because I believe it matters far more than most investors appreciate. The United States is now paying an extraordinary sum every year just in interest on its debt. Not paying the debt off, not reducing the principal, just keeping the machine alive. That distinction matters. A family that pays interest forever without shrinking the balance is not becoming healthier. A government is no different, except it owns the printing press and writes the rules. That is where the danger begins. When interest becomes large enough, the debt does not merely sit there. It starts governing the rest of policy. The central bank gets pressured to ease. The Treasury needs lower financing costs. Politicians need economic softness to stay hidden a little longer. But lowering short-term rates in a debt-heavy inflation, sensitive economy creates another problem. If inflation stirs again, investors demand higher long-term yields to fund the government. And if long-term yields rise too far, the debt spiral gets worse, not better. That is the trap. People talk about debt as though it were a static number. It is not. Debt is a moving organism. Its danger depends on rates, rollover schedules, confidence, inflation, and the willingness of buyers to keep absorbing fresh supply. When all those pieces cooperate, a very large debt pile can look manageable. When they stop cooperating, even a rich country starts making uncomfortable choices. I think the United States is moving closer to that uncomfortable zone. Not because I enjoy alarm, I do not. I dislike theatrical finance, but I respect arithmetic, and the arithmetic is getting harder. So let me strip this down to the simplest, honest version. There are only a few ways out of an oversized debt burden. The first exit is austerity. Spend less, borrow less, run surpluses, pay the debt down with discipline. That sounds clean in a textbook and nearly impossible in a democracy that has become dependent on deficits, entitlements, military commitments, and the political habit of buying time with borrowed money. The second exit is default, just refuse to pay. That would detonate confidence in the full faith and credit of the government. Shake the financial system and destroy far more than it solves. No serious government wants to choose that path voluntarily. The third exit is to grow faster than the debt grows. In theory, that is the beautiful solution. A productivity boom, a technology wave, a surge of real output large enough to make the debt burden smaller relative to the economy. That is possible over long stretches. It is not something you can rely on as a rescue plan for an already stressed balance sheet. Hope is not a financing strategy that leaves the fourth exit. Inflate the debt away. This is the exit respectable people discuss politely and ordinary savers experience painfully. It works like this. Imagine you bought a house with a $500,000 mortgage at the beginning. That debt feels heavy because it is measured against the value of the house and the value of your income. Now imagine a few years pass and inflation runs hotter than expected. Your paycheck rises somewhat. The nominal price of the house rises. Everything is quoted in weaker dollars. You still owe roughly the same mortgage balance in nominal terms, but those dollars are less powerful than the dollars you originally borrowed. The debt feels lighter, not because you became virtuous, but because the measuring stick got cheaper. That is exactly what governments do. The debt is measured in dollars. If inflation lifts nominal GDP and weakens the currency, the debt burden can fall relative to the economy, even while the debt itself remains enormous. On paper, that looks like progress. In real life, it means somebody paid, and the payer is usually the person who held cash, fixed income, or wages that could not keep pace. That is why inflation is such a politically attractive answer. It is a tax without a direct vote. It feels diffuse. It is difficult to blame on one person. It lets the government reduce the burden in real terms while telling the public the system remains stable. But stable for whom? That is always the question. For the debtor, inflation can be relief. For the saver, it is confiscation by slow motion. Now history becomes very relevant. After the Second World War, the United States carried a debt load relative to GDP that looked uncomfortably similar to where we have been again in recent years. The government had the same basic problem: too much debt, huge financing needs, a strong desire to keep borrowing costs from rising. The Federal Reserve and the Treasury dealt with that environment through direct coordination. Short rates were kept very low, long-term yields were capped. If market forces tried to push those yields higher, the system leaned against them. That was yield curve control in practical form. It helped the government finance itself cheaply. It also helped push the debt burden lower over time relative to the economy. But there was no magic involved. The cost was inflation. The saver paid. The holder of long bonds paid. The person sitting patiently in cash paid. The government deleveraged, and the public financed part of that, leveraging by watching purchasing power melt. There is a detail many people miss about that period, when the famous 1951 Treasury Fed Accord arrived. It was not originally about the central bank surrendering itself more fully to the government's financing agenda. It was the opposite. It was the central bank clawing back independence after a period in which debt management and monetary policy had become too entangled. That distinction matters because whenever people start talking about renewed coordination between monetary policy and debt management, they often speak as though it were technical housekeeping. It is not technical housekeeping. It is a choice about who bears the burden of an overgrown debt structure. And in the end, that choice always lands somewhere in the lives of ordinary people. I suspect that if policymakers try to manage the next stretch of debt pressure, they will want the benefits of easier financing without openly embracing the ugliest optics of money printing. That is where the modern version of the playbook becomes interesting. The old method was obvious: print reserves, buy long bonds, cap yields directly, everyone can see it. The new method can be dressed up as cleaner, narrower, or more technical. But the effect can rhyme with the same old objective: keep borrowing costs from exploding while the debt is quietly inflated down. One mechanism is balance sheet reconfiguration. The central bank already owns a great deal of paper, including mortgage-backed securities and longer-dated bonds. It can change the composition of what it holds without necessarily expanding the overall size of the balance sheet in a way that screams emergency. A shift toward shorter-dated treasury bills can create fresh demand where the government needs it most and make refinancing easier on the front end. That sounds sterile. It is not sterile. It is policy choosing which segment of the debt market receives support. The second mechanism is more important because it changes who becomes the buyer of government debt. Instead of the central bank openly acting as the great absorber of long-term supply, regulators can make it easier for the banking system to do the absorbing. This is where capital rules start mattering. If banks are constrained in how much government debt they can warehouse relative to their capital, then there is a natural limit to how much treasury supply they can swallow. Ease those constraints and suddenly a massive new buyer appears, not because the market discovered pure enthusiasm, but because the rules changed. That is a very different public story from outright quantitative easing, even if the underlying effect overlaps in an important way. Long-term yields get held down more than they otherwise would. Government borrowing remains cheaper than it would otherwise be. The debt burden becomes easier to carry. And the banking system, which sits close to the nation's deposits and credit creation, becomes part of the transmission channel. That is not a trivial detail. It changes who pays and how the payment is disguised. Most people think taxes arrive through legislation. Sometimes they arrive through financial architecture. If short rates are pushed lower, inflation stirs, and long-term yields are prevented from rising as much as they naturally would. Then the government gets a gift. It borrows at rates that may sit below the true rate of inflation. That is the essence of financial repression. The borrower wins because the real value of the debt shrinks. The saver loses because the real value of his money shrinks faster than the nominal statement suggests. This is an old trick. Very old governments with too much debt do not like honest pain. They prefer hidden pain. Hidden pain produces less revolt. The public may complain about grocery prices, rent, insurance, and utility bills, but relatively few people connect those everyday pressures to the strategic management of an oversized sovereign balance sheet. They experience the wound without seeing the knife. That is why I take this subject seriously. It is not about whether policymakers are clever. Many of them are. It is about incentives. A government drowning in debt has powerful incentives to choose the path that preserves the appearance of solvency while diffusing the cost across millions of households. Inflation does that beautifully. Not beautifully for you, beautifully for the debtor. This is why I am always suspicious when investors tell me they are safe because they hold cash and high-grade long bonds in a period like this. Safe from what? Safe from daily price volatility, perhaps. Not safe from purchasing power erosion. Not safe from a policy mix designed to keep nominal borrowing costs below the true speed at which the currency is being diluted. That is one of the great investor traps. People protect themselves from visible risk and walk directly into invisible risk. They hide from volatility and volunteer for debasement. The statement looks calm. Real life gets more expensive. That is not safety. That is slow loss in respectable packaging. If I were managing family capital in an environment like this, I would not anchor my thinking to nominal returns. I would anchor it to real purchasing power that changes everything. It makes me care less about whether an account balance stays flat in dollar terms and more about whether the assets inside the account can defend me against a deliberate shrinking of the currency's value. The assets that usually do better in that world are not mysterious, real assets, scarce assets. Businesses with pricing power, selected commodities, land, energy exposure, enterprises that can raise prices without destroying demand. These things are not magical. They simply behave differently from idle cash and fixed nominal claims when inflation becomes a policy feature rather than an accidental nuisance. That does not mean I would put every dollar into hard assets. Liquidity still matters. You must still be able to live, act, and take advantage of future opportunities. But I would be extremely careful about long-duration bonds in a system trying to suppress the real burden of debt. I would be careful about assuming cash as a long-term sanctuary instead of a temporary tool. Cash is useful for flexibility. It is not a place to build your entire defense if the currency itself is part of the release valve. This is the part where many people become emotionally resistant. They want the authorities to solve the problem without anyone paying. That is not how arithmetic works. When debt grows large enough, someone pays. The only real question is whether the pain is concentrated and obvious or spread out and disguised. Default is concentrated and obvious. Austerity is politically brutal and obvious. Inflationary repression is spread out and disguised. That is why it so often wins. Not because it is noble, because it is survivable for the political class. That is not the same thing as survivable for your purchasing power. So when I hear arguments that the system can be stabilized by cutting short rates, guiding long rates, easing regulatory channels for treasury demand, and avoiding open money printing, I do not hear a comforting master plan. I hear a sophisticated description of how the burden may be shifted onto savers. That is what investors need to understand. The trick is not merely to forecast policy. The trick is to ask what policy rewards and what policy punishes. In a world of financial repression, passive cash accumulation gets punished. Long-term nominal bonds get punished. Fixed income streams that do not reset well get punished. Real assets, selected equities, and scarce things often fare better, not perfectly better. That distinction is enough to matter. I think ordinary people also need to stop waiting for an official announcement that says your savings are now being diluted to help manage the national debt. No one will phrase it that way. The process will be described as support, resilience, stability, flexibility, or modernization of the framework. Fine, call it whatever you like. I care about the cash register. I care about the insurance bill. I care about the property tax bill. I care about the yield on safe assets after inflation. That is where policy stops being language and becomes life. And if the next 12 months move in the direction I suspect they might, many families are going to discover that they spent years worrying about stock market volatility while ignoring the much quieter risk of currency erosion. That is a very expensive misunderstanding. You cannot build a sound defense by reacting only to what is loud. Sometimes the greatest danger is the thing being done gently. I would rather own a collection of productive, real, and pricing power assets through a difficult inflationary period than sit proudly in paper claims whose real value is being managed downward in the name of stability. That does not mean recklessness, it means adaptation. There is also a moral element to this that bothers me. A society that repeatedly solves debt excess through hidden erosion teaches the wrong lesson. It teaches debtors that excess can be softened later. It teaches savers that prudence will be diluted. It teaches politicians that postponement is easier than restraint. Those are bad habits for a civilization. But as an investor, I do not get paid to lecture the civilization into virtue. I get paid to see incentives. Clearly, the incentive now is not hard to understand. Reduce the real weight of the debt without provoking a direct funding crisis. Do it quietly if possible. Spread the cost widely enough that nobody can point to a single invoice. That is the strategy I think people should be preparing for. You do not have to love it. You do not even have to agree with every detail of how it unfolds. You only need to recognize the direction of the pressure. Once you see that, the portfolio question becomes much cleaner. What do I own that can reprice? What do I own that can preserve scarcity? What do I own that does not depend entirely on the government's promise to keep the currency stable, while the government is incentivized to do the opposite? That is the real examination. If an asset fails that test, I want to know why I still own it. If a position exists mainly because it used to feel safe in the old regime, that is not good enough for me. The old regime was falling rates, endless rescue, and the broad assumption that bond ownership plus patience solved almost every problem. The new regime may be much rougher. In a rougher regime, old safety can become new fragility. That is not something I say lightly. I have made a career out of patience, rationality, and long ownership. I still believe in those things, but patience must be attached to the right assets. Rationality must be updated when incentives change. And long ownership only works if what you own can survive the kind of environment forming around it. So here is where I land. If the country chooses the unpleasant but politically workable path of financial repression, it may indeed ease the debt burden over time. It may work on paper. It may even be celebrated as proof that the system bent but did not break. The government may come out ahead. The balance sheet may look more manageable. The ratio may improve. But none of that automatically means the saver won. The saver only wins if he owns the right things while the adjustment is taking place. That is the difference between understanding policy and being protected from it. I would prefer you do both. Do not wait for the pain to become obvious. By then, the repricing will already be underway. Study the incentives now. Look at what the system needs. Then ask yourself whether your assets are positioned on the same side as the debtor or the saver. Because in a debt-heavy era, those two sides do not come through the cycle equally. One gets relief, the other gets eroded. I know which side I would rather be standing on.